My name is Camden Barbaria, and this is my informative speech on banks. So, whether you're buying groceries, paying rent, or shopping online, banks are involved. But what is a bank? Many people think of a debit card or a vault, but what a bank really is a financial intermediary, an entity that facilitates transactions between parties. For example, if I buy something from Amazon with my debit card, my bank is going to pull the money from my account and transfer it over to Amazon. And it seems simple in practice, but there's a lot more beneath the surface. In America, we operate under what's known as a fractional reserve system, meaning um, banks are only required to hold a certain amount of your deposit on hand at the bank at any given time. However, according to the Federal Reserve, as of March 26th, 2020, the reserve requirement is zero. And what that means is that banks aren't legally required to keep any of your deposit in the bank at any time. Think about that. None of the money in your bank account is guaranteed to be there at any given time. So let's say the reserve requirement was 10% for example's sake. It was a common level before COVID, but here we are today. So say I deposit $10,000 at the bank. The bank is going to put $1,000 aside, and then they're going to loan out the remaining $9,000. So if someone comes to the bank and asks for a $9,000 car loan, they're just going to take the remainder of my money and give it to them. And then they're going to take that money that they got from the bank, give it to the car company, who then comes back to the bank, deposits it, and then the cycle repeats over and over and over again. And as explained by Investopedia, my initial $10,000 deposit in the bank has effectively created over $90,000 in total money supply. And all the while, the bank is charging borrowers higher interest rates than it pays you to give them your money, profiting off your paycheck. And the system can work fine in most cases until banks and investors start underestimating risk, which brings us to the 2008 financial crisis. You've heard of it, but here's how it actually happened. So it began with something called a mortgage-backed security. When you get a mortgage, you pay the bank monthly in the form of interest payments over 15 to 30 years. And banks realized that this steady stream of cash flows was very valuable to American and international investors. So they started bundling thousands of mortgages together and sold slices of them to investors. And those slices, rather the bundle as a whole, those were known as mortgage-backed securities. And the government rating agencies that are in charge of grading investments gave them A+ grades, because after all, who doesn't pay their mortgage? And banks began making a fortune off these products, and they wanted more. So they encouraged lenders to hand out more mortgages, specifically to people with lower credit, because they had already given loans to the people with good credit. And these loans, which were known as subprime loans, according to the Brookings Institution, also known as crap loans, were the reason this crisis happened. And yet, even though these mortgages were bad, the rating agencies still gave them A+ ratings. And here's the shady part. The banks knew that these loans were risky. So they bought insurance on their own investments that they made with your money, called a credit default swap. So if borrowers stopped paying or defaulting their mortgages, the insurance companies would pay the banks. Default swap. And by 2007, housing prices began to fall unexpectedly. Interest rates began to rise, and millions of Americans, specifically Americans who had subprime loans, began defaulting. And according to the SEC, after mortgage-backed securities began to tank in value, the insurance companies who promised to cover all the losses were overwhelmed. They had to pay out billions in a matter of days, and many went under. At the same time, the banks, who thought they were insured were hit with massive losses. And the fallout, according to the Federal Reserve, was GDP falling more than 4.3% and unemployment surging over 10%. The CBO reporting 8.6 million Americans losing their jobs, household wealth plummeting trillions of dollars, and all this came from banks misunderstanding and ignoring risk. In conclusion, banks play a critical role in our economy, but the 2008 crisis exposes how dangerous it can be when these risks go unchecked. And understanding how banks really work and how your money flows through the system gives you power, and it helps you see warning signs. It helps you question the financial systems that seem too big to fail. And hopefully, it reminds us that the most dangerous investments aren't the ones we don't understand. It's the ones we think we do.